Welcome to today's program on investment strategies, what's working now. I want to thank you for coming, and I'm excited to have you here to learn about strategies that will help you minimize risk and hopefully outperform the market over time. We're going to discuss today some individual ideas and strategies about how to protect capital as it's growing and how to minimize the risk of loss when it relates to stock and bond market risk. So we'll look to our back here and see the chart of the S&P 500, and in this chart we can see immediately what the risks are to being a stock investor. And in this chart we see the volatility that has come from being an investor as a buy and hold investor. And what this chart flow is showing us is the S&P 500 and the big ups and the big downs that it's happened over time. So many would agree that being an investor in the market, it makes sense for the long term. But as we enter into the years of retirement, it might be we don't have as many long-term years to weather the storm when markets decline. So let's talk about some strategies, and in part of the handouts that you got, there should be three. There should be this checkerboard looking thing here. Everybody has this. It is a brochure called Using Active Management. We'll refer to that as well. And there's also one last piece which is considered a fact sheet called Tactical Market Leader. I'm going to refer to these three pieces through this portion of our workshop. And let's start with this chart here. This comes out of the piece called Using Active Management that I'd like to kind of bring to your attention some of the historical risk of being an investor in the market. If you look to the far right, bottom right, which identifies this list, this is giving us a historical perspective of what it was like to live through the market declines in the past. And one way to read this is if you take the year September 29 to June 32. That was the Depression. And what happened during the Depression is the market dropped for 33 months. That was the duration of the decline, and it dropped how many percent? 86.7%. That meant $1, $10,000, $100,000 lost 86% of its value down to something close to $14,000, $13,000. Now the number following it in the column that shows that it took 25.2 years just to come back and break even. Now that's pretty shocking. Now that's the worst. But if we look, we can see each of the various bear markets that have happened, how long the duration, how long the years to recover. And what we notice that even in the shortest declines, and this is the most recent, it took 5 or 6 years or longer for the markets just simply to recover from a loss. So again, for many folks, especially when we are needing to draw from our assets, can't maintain the income we need if our portfolios are dropping at such dramatic rates, or potentially dropping. So what can we do to protect ourselves? There's two styles of investing. And one is the classic buy and hold investor who traditionally buys the market or the market index and simply holds it through all ups and downs of the markets. The other is called tactical, and tactical is what we're going to talk about more tonight. Tactical is a way of investing that is designed to try to minimize risk. And the way, or if you will, the name tactical comes from tacting is a sailing term. And I'm not a sailor, but to define it the way I understand it, in tacting, you have the wind and the sail, capturing the wind and maneuvering according to the breeze that's blowing. So tacting, moving in and out to capture the most of the gain of the wind. It's movement. And so if we think about the sailor term of tacting if you're in a sailboat and you're in a violent storm, ideally you would rather not be in the storm while it's happening. But if you're in a sailboat and you have a sail and it's storming, what do? You drop the sail. And the reason you drop the sail, for you sailors in the group, is if the wind blows too hard, what happens to the boat? It topples. So I think the analogy of the wind, the waves and the sail being fully exposed means that you could do great damage in the markets as an investor if you're fully invested during the more volatile periods of the market, correct? So let's talk about what that might look like if you were successfully tacting in the markets. Again, your flyer piece, I took this out of that, defines, in the perfect world, what would that look like as an investor? And in the way to see this chart, the blue that you see here is a classic buy and hold visual. And that is, if the market is going up, you're riding the wave of the market up. If the market is going down, you're riding that wave down, correct? If you're tacting, or you are tactically managing money in a way where you can step away from the market decline by getting out of the market and preserving the capital by being out of stocks when it's dropping, right? Your money's not dropping with the market if you're out of the market. And then when markets head back up, you move back into the market. And I'm illustrating using a mutual fund. If I own a growth fund and I'm in it when the markets are going up, it would go up. If I'm in a money market fund, I'm getting out of the market and I'm moving money to safety, a safe harbor. And if I do that properly, and this is theoretical, that maybe I have more money at the tail end than I had by buy and hold, and I sure might have had a whole lot less upset or emotion, the roller coaster ride emotionally, right? So let's look at how we might think of investing in a way that would take advantage of tactical strategies and help us make decisions about how to invest to protect our money. And these are the top decisions that you and I have to make if we're an investor. One, what should you buy? When should you buy or sell? And how much should you buy or sell? These are the three things you need to answer for yourselves. If you don't have all the answers to these three questions, then you shouldn't, in my view, be an investor, because it's dangerous not having a strategy to know those three things. And the way we can determine what strategies may have worked best is by looking at the past. And this is in your handout, which is the chart that you see with all these cute colors. What does this remind you of from school? Periodic table, exactly. So if you think about this, this is a periodic table of investing. And the way to read this is each year at the top list the 9 asset categories. And those 9 asset categories represent over 90% of how you and I can invest in the marketplace: stocks, bonds, cash. Specifically, they're color-coded, and you can see, for example, small cap value, 22.83. That's the return of the small cap value asset class in the year 2000. Everybody with me? And you can see it's from highest performer to lowest performer, which was small cap growth, that lost how much? It lost 22%. These 9 asset categories, 7 of them are stocks. 2 of them, one of them is CDs, which is the bank CD. The other is aggregate bond. So we have a selection of stocks, bonds, and cash, or CDs, represented in those squares. Okay? So let's play a what-if game. And the what-if game would be, what if you had $100,000? And what if we went back to the year 2000 and simply invested your money and held it and let it compound? What would it have grown to? So if I look at it, the first and easiest example would be, what if I put money in a CD? and each year just simply roll to the CD year by year, let it compound. And what would have happened at the end of the 10 years? Or, I'm sorry, 15. That $100,000 grew to $142,000. And for right now, I'll come back to the 2008, but what I was trying to define for you or compare to is what was the return in the year 2008 that strategy did. So fixed investment guaranteed, $100,000 grew to $142,000. The return for 2008 alone was 3.14. Okay, everybody with me? Now, what if you diversified your money and you took your $100,000 and you equally split it up amongst the 9 choices? Okay, and every year you just rebalanced equally to the 9 choices. Now that would be pretty diversified, right? Okay, you have stocks, you have bonds, you have cash. So what if we call that equally diversified buy and hold. So I diversify, I hold, at the end of the year rebalance and I hold. Everybody with me? Rebalance and hold. So that 100,000 grew to 226,772. So we can argue that, boy, this, and by the way, this is where maybe the greatest percentage of advisors are in terms of how they advise people to invest. They simply recommend, well, we don't know what's going to happen in the future, so simply asset allocate, diversify, and rebalance, and that's their view of the best way to invest. Now, some of you may be doing that now, diversifying and allocating, maybe, yeah, maybe no. But let's look at what happened in that process, or that strategy in the year 08. Everybody see the negative number? Now you got to ask yourself this question. Wait a second, the greatest guys, thinkers in the investment planning suggested you ought to diversify and asset allocate, and that would buy you some form of what? Protection against the market. Did it? Oh, no, no. It didn't do it, and we don't know all the reasons why it didn't, but what we do know is that something changed in the marketplace. What theoretically should have happened is that stocks were offset by bonds or offset by CDs. It did not happen. There's some theories out there that suggest that maybe markets are changing. I mean, I don't know. But the point is, the proof of the pudding is it didn't work in 08. There is a strong likelihood that this can happen again in the future, that being simply diversified won't protect you against severe market downturns. So let's look at some other ideas. Now, this is kind of stretching the imagination a little bit, but bear with me. What if we came in as an investor January of 2001, and we look in the past at last year's winter, and we bought last year's winter January 1 of this year? Okay? So January 1, I buy small cap value, and I hold it till the next year. Okay? I go to January 02, and it just so happened in this illustration that small cap value happened to be the winner 2 years in a row, and I would have bought that again and held it for the next year. Everybody with me? You see what I'm doing? So what would have happened historically, at least over this time frame, and we call this rotational equity leader. And that means buying the prior year winner, holding it for 1 year, and what we're seeing happen is something kind of interesting. What's interesting is it certainly did outperform, didn't it? Now, this is not to scale, and if it was, you'd see the difference between 302 and 226 is a pretty huge percentage. So we see a dramatic increase in return by having purchased last year's winner. This may be due to something you all and we all learned in high school. You remember in physics, who was the founder of motion, or the laws of motion? Newton. Sir Isaac Newton. And he came up with this idea that a body in motion remains in motion until an opposite force, mixing it up here, but until an opposite force it pushes against it in essence. So, in other words, a body in motion remains in motion until not. And the theory with that is, in the short term, something that is moving one direction tends to continue that direction, at least for a short period of time. At least that's what studies in financial planning, or in terms of research of stock pricing, suggest that there is a momentum called persistence of performance that is happening in the marketplace, that at least in certain time frames, that what's going up tends to continue to go up. Everybody there? Okay? So what has happened with equity later, it's capturing in that 1 year period of time, it's capturing the momentum of a winning stock or a winning index. Okay? Now, take that concept a little further with me. Oh, but I didn't point out, here's the negative. Yeah, I did indeed increase my return, but what happened in 2008? It was actually a little worse in its decline, right? So yeah, gee, it's nice that I earned more money, but I took on more risk or more volatility, correct? So I don't like that number. So what can we do to improve it? Well, one way might be, what if we, instead of waiting one whole year to make a decision about whether to be in or out of an asset class, what if we looked at something a little shorter term and used something called moving averages to help us make a decision when we should be out of the market or in the market? This is an example of a 12-month simple moving average. And we're looking at the S&P 500. And a 12-month moving average is this line here, the blue line that you see here. It takes, these are data points, the S&P 500, 12 closing prices of the S&P. This is the S&P index. This is years 1995 forward. But what it does, it smooths out. It takes the average of 12 data points and it moves it forward. It's called a moving average, right? And the theory here would be, what if I simply own, in this example, the S&P 500 stock market index, only when at the end of the month that the price of that index is above its 12-month moving average? What if I just own it then? And if ever it drops below at the end of the month, I just get out. Well, what's interesting is you look at this, I mean, there's no perfection. I mean, there are periods when it gets shaken out, right? Like here, it went down just a couple of months and then it bounced back. But what you see is that mostly it captured the gain of most of the market, but equally, if not more important, it missed most of the loss. Everybody with me? And you see here it participated in most of the gain. Here it missed, because I would have gotten out here, missed most of the loss, right? So if I look at this, this is through May of this year, 2015. So if I look at this chart and I apply that to a comparison, and here's the comparison. What if I put money following just simply this logic? I'm in the market when it's above the moving average and I'm out. And this is what this illustration is showing you in terms of graphs. If I put my money, 100,000 in what is called the buy and hold, meaning I just bought the index and held it through all market ups and downs. That 100,000, I'm not taking out taxes, it's just showing you growth, grew to 458,000. Everybody see the number? But what's happened is, by following a tactical approach, the amount of money ended up being greater. But this is what I think is more important, is that it minimized the volatility, right? The up and the downs. In other words, I may have had some up and down periods, but nothing like the extreme movement of a buy and hold portfolio. I know sometimes we talk about this, and as investors you may have had the experience, but if you own something that's dropped like a rock, what's the temptation to do?
Sell it.
Sell it. Get out. Because of the risk, because of the fear. And so if I can own a growth investment that is more moderate in terms of its risk, I'm more likely to hang in there, right? I'm more likely to hang in there during the tough times by taking away a lot of the volatility of that movement. So that's illustrated, I think, well here. So if I took that same 12-month moving average concept and I took, you remember the market leader was buying last year's winner? If I bought last year's winner and each month simply looked as it above its 12-month moving average, and I held it, and then if it wasn't, I got out of it and went to cash. What happened was my 100,000 grew to 332, which was certainly higher than this. But what was more impressive to me is that it had far less market decline, just a little over 10% during the year 2008. That is, again, that is a substantial reduction of market volatility and risk, okay? All right. Now, having shown this to you, I will tell you I'm still a little bit not happy with a 10% loss, okay? Although relative to buy and hold, it was still far superior. But there are other ways to reduce risk, and I will lend you this word of caution, that if I gave you some ideas with this 12-month moving average that you could go home and do yourself. But I will also tell you that there are things that you can do to make it better without taking on, actually with reducing the risk. I always tell my potential clients this too, that if you are not the kind of person who wants to watch this sort of thing day in, day out, or month in, month out, or you're not going to be diligent to follow it, don't ever do this, because it's always that one time you don't look at it or don't respond to it that the market can do the ugly and you lose all you've worked for. So, and obviously my view is that you consider professional management somebody who is doing this. So here's what we do, and this is just to give you an idea at Wall & Company. We analyzed, like the 9 choices you saw, those asset choices, we take the top 7 broad market equity styles. We exclude CDs and we exclude bonds. We're just talking on the equity side of growth. We then take and monitor for the top ranked ETFs, which is it's a stock. An ETF is an exchange traded fund that mimics the indexes that we track. It's just a low cost way of being invested in the markets that we want to be invested in. And we use market trend analysis using various technical indicators that tell us when the market's in an uptrend and downtrend. So I shared the example of a 12-month moving average with you. There are better ones. Some of these are proprietary, but what they are, what we found in our research is that it provides a better mechanism of being in or making the decision of when to be in and out of the markets. We then buy the top ranked market leader that we've done by analysis, but instead of waiting every year to make that decision, we do it every single month, every 30 days, okay? So the reason being is that the markets can change so quickly, rather than waiting a whole year, we want to respond to it in a quicker, faster fashion. So part of your handouts, I think, illustrate the growth of our tactical, Wallco Tactical Leader. And what made that one not only attractive because it outperformed, and that's what this piece is right here, what made this very attractive to us is that the rate of reduction, even during 2008, even though it was a growth investment, had less than a 1% decline during 2008, which was the very bad year to be an investor. So, now why is making this kind of decision about how to manage money important to people going into retirement? It's how you're taking money off the portfolio for income, isn't it? I mean, how are you generating an income stream? So I want to show an example of 3 investors, Connie, Peter Hope, Sammy Sabby, and show you how they each did it differently. They all retired. Connie came in January of 2000, with $300,000 and only wanted no risk CDs. So she put her money in the rolling CD performance. She took out $21,000 each year, inflated 3% a year. So $21,000 going up 3% each and every year. And again, only rolling her money in shorter term 6-month CDs. So her portfolio, which started at $300,000, is now at $14,973, and she's not quite destitute is the word I want. I mean, there's a little bit of money left over, but she's certainly not real happy about that. Peter Hope, he had heard from his advisor, just simply take your money and diversify it. Spread it across all those asset classes, those non-asset classes equally, and draw off the portfolio that same amount of money. He wanted the same $21,000 adjusted for inflation. He followed the buy and hold and rebalance process. And he is not real happy either. His money is now at $36,000. He's not quite yet destitute. He's certainly very concerned. So Peter followed the advice of diversity, spreading it out, rebalancing, and is now close to zero for doing so. Sammy Savvy heard about this thing called tactical investing. He applied it to his portfolio. He took the same level of income, the $21,000 out each year, invested for inflation, and obviously Sammy's numbers were far higher. Sammy's confident that he can weather the retirement storm, if you will, the future, the volatility of the market's ups and downs by following a strategy that at least he's feeling confident will help him weather the storm. So if we compare the three, we see a definite difference of how strategies can impact us as investors and impact us as retirees when we're at that point and stage of retiring, pulling money off our portfolios. And in our class, we talk about the yellow money, the green money, and the red money. And as you know, we believe that most of us should still have money in the red money bucket. So the question begs, what strategies do you use for the money that you have invested in red money to help protect you? So this is one of the things that we might recommend to you to consider is tactical investing. I do need to tell you that past performance doesn't mean it's going to happen again in the future, and this is a disclosure telling you where the numbers came from and how we generated them. We also have to tell you that these are hypothetical clients and hypothetical data. It's just to illustrate a point so that you're aware of different choices. So here's some thoughts I want to end on. Thought number one, for the red money side, playing it safe could be the highest risk strategy of all. That's the Connie conservative story. So if you think about what happened to Connie is interest rates did what over her period of years? You know, low, 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 low. But yet her needs for income did not drop, did they? They actually increased by the rate of inflation. The buy and hold strategy is, in my view, not a strategy. And the way I think about that is this. How many of us would rush out and buy a car with no brakes on it? But isn't that what the common wisdom is today of buy and hold? Oh, just buy the stock, just buy the index, and just simply hold it. Well, shoot, you know, that might work if you have a lot of years to go. But in the game of income planning and the needs to start drawing off income, you can't afford to have a brakeless car. You need to be able to be more cautious with dollars. Tactical leader, this is the Sammy Savvy story, is think and consider about using tactical strategies and management strategies to help minimize risk. These are 5 reasons why, in my practice, I think people fail in terms of their planning. And reason number 1 is emotions. They let emotions get in the way when they're as investors. Number two is they overpay taxes. They're not paying attention to what the best tax strategies are to prepare for their futures. They ignore the negative impact of inflation. And when I use the ignore, it means this. It means that you are not generating a return greater than the rate of inflation, which means that you're losing purchasing power in the long term for the monies that you need in your retirement. So if you are overweighted in yellow money, lower yielding money, then you've given up that return that you could have generated potentially in green or red to offset for the negatives of inflation. Having no financial plan, not knowing where you are today, what your choices are today, what the better choices are for you to make, and implementing those for your future. And maybe the worst, and this is procrastination, and procrastination is simply knowing that you should be thinking about and doing things differently to accomplish the goals that you need to accomplish. There's this great man that we all know who had this theory of what insanity meant and is, and we all know the definition of insanity, right? It's repeating the same things we're doing but having a different expectation or result, or a different expectation or result in the future. So as it relates to the red money investing game, you would not believe how many people I counsel who have lived through 2 bear markets in the markets and have seen their money creep back higher thinking it's never going to happen again. And I would suggest to you that it will. We just don't know when it will, that markets do go back down again, and that we need to be diligent in how we look at what we're doing and managing what we're doing to protect ourselves. So thanks for attending. I appreciate your engagement in this process and teaching. I'm going to open up for some questions, and so I threw a lot of ideas with you on the investing piece. What questions may you have?